This is David Russell, Global Head of Market Strategy for TradeStation. And today we'll look at major events for investors and traders. Stocks could be tightening into a range as investors wait for another big Federal Reserve meeting. The S&P 500 fell slightly between Friday, September 8th and Friday, September 15th. It was the second straight negative week and the second consecutive week that prices remained inside the previous range. Back-to-back inside weeks are rare. The last time it happened was in February 2018, according to TradeStation data. That kind of narrowing range may reflect significant uncertainty, with the potential for a big move in either direction. Wednesday's Fed meeting as the likely catalyst for prices to start moving again. With policymakers widely expected to leave interest rates unchanged, attention will focus on guidance for the next meeting on November 1st. Traders will first check the summary of economic projections, or dot plot, at 2 o'clock Eastern Time. Then they'll watch Chairman Jerome Powell's press conference, 30 minutes later. Indications that the central bank is finished raising interest rates could be positive for stocks. Suggestions of higher rates in November could have a negative effect. Last week had a mix of hawkish and dovish news. Strong economic data, like retail sales and initial jobless claims, might argue in favor of higher rates. However, core inflation readings mostly matched estimates. Shelter costs rose at the slowest pace in 2 years. That's potentially important because rents are the largest component of inflation, and economists expect them to decline. For the second time in the last 4 weeks, Tesla was the biggest gainer in the S&P 500. The electric car maker jumped after Morgan Stanley said its Dojo computing system could add $500 billion of market capitalization. It also benefited from strikes at the big three automakers. J.M. Smucker was the biggest decliner. The food stock shed 10% after agreeing to pay $5.6 billion for Hostess. Utilities were the best performing sector last week as they continued to rebound from long-term lows. Financials also outperformed as Citi announced cost cuts. Precious metals jumped. They could benefit from the Fed pausing rate hikes. Technology stocks broadly fell after Apple released new iPhones. Home builders, which surged in the first half amid strong demand for houses, were the worst performing group overall last week. Now we'll chart the market. The S&P 500 fluctuated less than 65 points between its high and low last week. That was its narrowest range since late June. Some chart watchers may notice a falling trend line along the highs since July. A move above the resistance could make them expect continued upside. A break to the downside could make them expect a longer period of consolidation. The first area of potential support is at the September 7th low around 44.30. Below that is 43.35. Where the index bounced in June and August. Two other charts could be important. First, crude oil futures ended last week above $90 for the first time since November. Further gains in energy prices may trigger more inflation worries. Second, the yield on the 10-year Treasury note had its highest weekly close since October 2007. More increases could make investors worry about the economy and stock prices. This could be especially important around the Fed meeting. Now let's look at the week ahead. Aside from the major Fed meeting on Wednesday, this week features several important housing numbers. Few companies report earnings. Attention could also focus on the auto worker strike. Homebuilder sentiment is due this morning. Housing starts and building permits are in the pre-market tomorrow. Wednesday has crude oil inventories in the morning, and the Fed starting at 2 o'clock. General Mills and FedEx issue quarterly results. Initial jobless claims and existing home sales are due Thursday. Nothing important is scheduled for Friday. Thanks for watching. Please visit tradestation.com for more.